Awesome. So I just wanted to thank everyone for joining us today and welcome you. My name is Caleb Jennings. I'm a branch manager with the CAMS Jennings Group at Guaranteed Rate. And I'm just super pumped about 2024 because 2023 was such a tough year. I don't know about y'all, but like 2023 was pretty tough. Certainly it was tough for me as a loan officer. And I know a lot of our realtor partners, it was tough as well. But the good news is I feel that what we're seeing is the market starting to shift, which means there's going to be a huge opportunity for those of us that survived 2023. We're coming through stronger, and huge opportunity to grab market share. And that's what we're all about as a team, is that we want to partner with you to give your client an amazing experience, but also to help you uh, get to the closing table and close more business. So I wanted to introduce our VP out of Kentucky. Dustin, you want to introduce yourself?
Hi, everyone. Dustin Jennings here. I'm the Vice President of Mortgage Lending with the CAMS Jennings Group at Guaranteed Rate. And I work out of Louisville, for those of you who don't know me. I'm really excited. It's a privilege to have you all here, and I'm really excited for the new year,
Awesome. Yeah. So Dustin's a rock star, and I see a lot of folks that are here today got invited by Dustin. So like we're really proud of the work that he's doing. He's kicking butt in Louisville, Indiana, that market as well. So just, if you got business, get it to Dustin. He's going to get it done, and we got his back all day. So we're just really excited. So thank you for coming. And then John Cams, who's my partner and co-branch manager, he's going to be doing our presentation today. So what I'm going to do is I'm going to go on mute, and then I'm going to hand it over to John to go ahead and take it from here. And what we'll do is if you have any questions, drop them in the chat. But we will, once John wraps the presentation up, we will open it up for questions as well. So I will let John take it from here.
Hey, everybody. Thank you so much for coming. Can you see the screen here? Good. Okay, great. So 2024. Supply and demand. It's always about supply and demand, right? Prices and demand. So today we're going to talk a little bit about where we see interest rates going, why we see them going there. I'm sure you guys saw the Fed said they're going to pause on rate increases, and there's just a lot of misinformation out there. I talk to clients every day. A lot of clients still think rates are 8%. Rates have come down tremendously in the last 70 days. They've come down to the tune of about a 1.5%. Now we're looking, call it on a 30-year fix, 6.5. 70 days ago, we were at 8%. So the opportunity right now is tremendous. There's a lot less people in the business, and being able to be armed with this stuff, these graphs to explain this stuff to clients is pure gold here. I saw something today. Every day I wake up and I read the Google News, and the headline was real estate market set to crash in 2024 and 2025. So I opened this up. I'm like, wow, I bring this up because this is what our clients are reading every day. And you do a deeper dive into it, though, it's complete clickbait. It's basically this guy saying that, yeah, commercial loans where these loans are resetting, and you're going to have people who walk away because they're not going to want to take the higher interest rate on the commercial loan. But it's totally commercial lending. It is not real estate. It's not housing that you and I are dealing with. But again, your clients just see the headline. So this presentation is gold to really help you combat them with that as to whether or not now is the time to buy. So we'll go ahead and get started here. So let's talk about inflation. So the main driver of interest rates is inflation. And right now, year over year, the numbers came out this last month, but this presentation was done shortly before that. But year over year right now, the core CPI, Consumer Price Index, is 4%, and the core personal consumption expenditure is 3.2%. This is what the Fed cares the most about. Now, what's interesting is that within this is a shelter component, and within both the core CPI and the core PCE is a shelter component, and the shelter for CPI is 44% of the CPI is this shelter figure, and for the PCE it's 21%. So the reason I bring this up is that if you look at what Shelter is actually doing right now, Shelter is at 2.5%. If you look at the blended current Shelter rate right now, but if you take a look a little bit further, this is what the Fed actually uses. So the Fed uses a trailing average. So they take the last 12 months and average it, and they use this for the CPI. So as you can see, there's a huge lag effect as to what is actually where we are actually and what the Fed uses within these numbers. So if you take into account the fact that Shelter is actually 2.5% right now, but the Fed's using 6.7 for the personal consumption PCE and 6.5 for CPI, when you take into effect the lag effect, this is the real CPI if you were to use the Shelter of today as it catches up. Like ultimately, these eventually catch up with each other, but because of the lag, they don't. So right now, core CPI when accounting for this lag is 2.2%, and the core PCE is 2.3%. The Fed already said when they said they're going to start cutting rates, they said they are not going to wait until the inflation is at 2%. They're going to reverse course, start lowering interest rates and then hopefully catch the 2% on the downside. So the question is, what they did not elaborate on is when they are going to do it and what interest rate or what inflation is going to be. But again, if you took it right now here with this lag effect, core CPI would be 2.2%, core PCE would be 2.3%. One thing that the Fed has mentioned that they are doing is they're looking also at the last 6 months. So if you took it the last 6 months of just the current numbers right now and accounted for this, inflation's actually under 2%. It's at 1.85%. So now let's talk a little bit about Shelter and how it's in the CPI. And what it does is, like I said, the Fed has a little bit of a wonky system. It takes the last 12 months and averages it. But what it does is it takes the Shelter component and compares it with the last months, and that's how they come up with the figure. So if you look here, last year, Shelter came in at 0.79%. So this is what it was going to be replacing. And the point here is that Shelter, if you look in January and February, we have really high replacement numbers, which is going to be another tailwind for the Fed to lower interest rates. And if you look, we have basically pretty high numbers that we're replacing here in January and February, which should bode well for interest rates coming into this spring market. The question is, when is the Fed going to cut? As you see here, as we go on throughout the rest of the year, it may be a little bit harder to gain some traction here with the Shelter component because the comparison numbers from the previous year get harder. But these next 3 months look to be very could bode well. Rates should continue to at least stay where they're at, which is a lot better than 8%. Like I said, they're at 6.5. I'll take that going into a spring market all day. And if we can get a little bit of a push, maybe even get them to the high fives, it could be well, as far as buyers coming back into the market. So let's talk again a little bit about these expectations for inflation and the Fed cut. So what we're doing here is basically kind of saying, hey, if you take this year over year Shelter of and let's just estimate that it comes in at 0.1%. In December, which the PCE actually did hit this. CPI last year missed expectations a little bit, but the PCE did hit this. So this actually did happen. So let's just say that December 1st, we hit these numbers. And so like I showed you in that last graph, we have those 3 months where we get the good comparisons. So let's say that we get PCE gets 0.1, goes up 0.1 in February, January, February, March. That basically is going to replace a 0.39, which means that what you'll see here is this is basically what the core PCE is going to be every month. So we're estimating at the January 31st meeting, the Fed's not going to do anything because if you look, core PCE is still going to be at 2.87. But as we go on through the year, you're going to see that if these hold true, which all signs are indicating that they will, March, April, we are going to be at that Fed target. So there's a lot of stuff going on. I don't know if you guys have been reading, like some people are, oh, the Fed's not going to cut. It's going to take longer for them to cut. If you remember correctly, just before December, they said that they don't see the Fed has reversed course so many times and they're always have a hard stance and they end up doing way more than they say they will. But just based on this, the fact that inflation is going to be at this target, rates are coming down. And it's not a question of if, it's just a question of when. So yeah, this is just basically showing like the market odds, right? And this got a little bit affected here. It was at 70% when we made this this slide or this presentation, and then it went to 90%, and then just as of late, it went back down to 70%. So the futures market is basically betting right now that with 70% certainty that the Fed's going to do their first cut in March, and then if you look, obviously June, July, they're 100% rates are going to be the Fed's going to start cutting the Fed funds rate. So this, I just want to talk to you a little bit about the dot plot. So I don't know if you've ever seen this, but this is basically an anonymous voting chart of where the Fed sees interest rates. So this is 2023, this is 2024, this is 2025, this is 2026. So this is anonymous members and what they see the Fed funds rate in 2024. So you have two people who say there's not going to be any cuts. You have one person who says there's going to be 25 basis points cuts. Five that say there's going to be a 50 basis point cut, 8 or 6, 7, 75. So the consensus is somewhere in this 50 to 75 or 100 basis point cut. So, but what is interesting is that if you look, where does the Fed see interest rates in 2025? Where do they see them? Where do they see this target rate? So right now we're at 5 to 5.25. We're here. So with the overwhelming majority of Fed members see us being in the 2.5% interest rate, or 2.5% Fed funds rate into 2026. So if you made it through 2023, congratulations, because we're going to get a tailwind here of rates continuing to go down. And you're going to see that if you bought here, as we all know, this is cliche at this point, and refinanced here, this is very supportive of prices being continuing to rise as they have been. One other thing I think that is important that the people don't really take into account is that the Fed has a balance sheet. If you look, this is basically what the Fed has been investing in mortgage-backed securities and treasuries, and they've been basically buying them from the government and buying Fannie Mae, Freddie Mac bonds to the tune of 8.5 trillion. So if you look here, this was during the financial crisis. Coming out of here, the Fed started buying mortgage bonds to keep the market, keep interest rates low. This is COVID. Look at this crazy amount of spending, all this stimulus that they did to drive interest rates down to the 2.5%. So the Fed basically has now said, hey, you know what? When they reached their peak in April 2022, 8.5 trillion, the Fed basically is not comfortable with this much on their balance sheet. So they have actually started selling mortgage bonds and treasuries, and that's been flooding the market and making interest rates go up. So the question is, when is the Fed going to stop offloading? Because what you can see here is that when the Fed had from the range of 2014 to 2018, they basically had 22%. They had 4,250. But you take this percentage of the GDP we had, it was 22%. And then pre-COVID, they were at 21.3%. During the peak, they had 33.2% of the balance sheet versus GDP. So that's when they started basically offloading these bonds and flooding the bond market and increasing supply, driving the prices down of these bonds. And when that happens, rates go up. So if you look, though, as they've gotten on track to where they are now, since they've been offloading the balance sheet, they're down to 25.6%. So if we can estimate when the Fed will be back to where it was on the balance sheet before they started pre-COVID, and that's basically coming into the last half of the year here. So the point is that the Fed, on top of basically inflation coming down, if the Fed stops their balance sheet runoff, that's gonna take away that added supply to the bond market, which is another interest rate friendly thing that could happen that your buyers should be aware of, because all signs, this is just another, because a lot of people have said like, oh, how are we going to pay for, if Biden gets elected or whoever, we got all this debt coming on. Well, a way to do that would be the Fed stops their balance sheet runoff. And as you can see, they're pretty much getting back down to where they were at the end of the year, to where they were comfortable. And then obviously we have a recession that is the Fed. If the Fed does stop that balance sheet runoff, and they tighten too much, then we obviously could be in a recession. And as everybody knows here, if we're in a recession on top of that, that always bodes well for interest rates. So where do we see mortgage interest rates in 2024? So we see the 30-year fixed mortgage rate in the mid to high sixes, under 6. We believe should start to unlock some of these move up buyers. And we see the 10-year treasury being anywhere from 3% to 4.4%. Now, keep in mind, this is not, as interest rates come down, it will not be in a straight line. There's going to be days where it goes up. The last couple of days, the Fed's Waller governor came out and said some bad comments and rates ticked up a little bit. But we do ultimately see rates continuing to come down. Real quickly on inventory, as we know, inventory remains extremely tight. You look at this, I remember 2019, I sold a property in 2019 that we had to take a loss on. And then you just seen that even from 2019, we had 1.75 million, and we're still have just over 1 million in inventory in 2023. But I do like this graph here right now, just because it's awesome. That we'll get you a copy of the presentation if you guys want it. But this is just basically showing formations and completions. So formations are real new households. Like if you just move, but you didn't create, like if you move from one house to another, that's not a formation. A formation is basically a new family that needed a new house. So the blue is the formations and the yellow is completions. And it's just basically showcasing that there are just not enough homes being built for how many formations. So prices should continue to go up no matter what anybody says to the contrary. The other thing we wanted to touch on a little bit is affordability. I'm sure you guys have heard this from all your clients and the media, that it's just not affordable to buy a home anymore. And not to say that it's not, but you look at this is kind of what the evil of inflation does, right? I'm 47. I still think $100 is a lot of money. That was up until maybe a couple months ago. I thought that, right? But so affordability, it's not as bad as the media claims. And we just wanted to do a real quick rundown here. So let's say you bought in 2021 and your monthly principal and interest payment is $1,000 and you got an interest rate of 2.875 and your monthly income was $4,000. Today, that payment's $1,800 and you had to buy it at $280,000 and the rate is 6.625%. So that means it's $800 more, which is an 80% increase, which is very significant. However, income has gone up since 2021 15%. So while the payment has gone up, it's been it's a 20% increase in the payment when you factor in the fact that people are making 15% more on average from 2021. So what is our real estate appreciation forecast? We're forecasting nationwide 4.5 to 5.5% appreciation, and this is the great news. Transaction volume up 15 to 20%. We are very excited about that. So we hope you enjoyed this presentation. Again, let us know if you want a copy of the presentation. We can go ahead and open it up for questions now. Or if you guys, any general comments, if you guys want to talk about how the market's going for you. Anybody want to say hi? Who do we got on here? Afra. Hey, Afra, how are you?
So
All right,
yeah,
I'll start
we'll get
off.
everybody a copy. And did you say you were gonna say something, Eddie?
Yeah.
Go ahead.
So my numbers are showing that we nationally did about 4 million transactions. And
Okay.
so you guys are looking at 20%. So you think we're going to come in at about 4.8 million next year then?
Yeah,
Okay.
15 to 20% increase.
Yeah, due to the 20%. All right. So that's where I'm showing, because that's where I had was I think we're going to be closer to 5 actually, because I still think there's huge pent up demand, but we'll see.
Yeah, no, I think that I mean,
Normal years like 2019, 2018, we were around
Yep.
5 to 5.5. I don't
Yep.
think we're going to get to 5.5. That's a huge jump.
are you saying in appreciation?
No, I'm talking about in transactions. It's
Oh,
not
yeah.
the appreciation that's killing individuals in this business. It's the
No,
lack of business. It's the lack of transactions. You
No,
know,
for sure.
I mean, we all know supply fell with demand. Demand did go down, but so did supply. But as these interest rates come back, you're going to see demand rise again.
Oh, absolutely.
No, I mean I've already seen the market loosen up a bit when rates dipped a little bit. We have buyers that have been sitting on the fence for the last 6 months, to like waiting for rates to come down, and it's this movement starting to get them to come out. So I'm definitely feeling an uptick in applications that we're getting to get pre-approved, and we're seeing it already. So I think I think the key thing that we need to do is just to stay focused on the basics of what we do to get our business. And I think if you're focused on the basics of getting business every day, and when this market shifts, it's going to be great.
Kim's got a great question in the chat.
Yeah, so Kim says, I don't want to, not to get political, but discuss presidential election year in terms of rates, et cetera, as predictions. If X wins, Y wins. John, so there, everyone has an opinion on this, but as far as
that's a good question. And one of the things that I forgot to mention about that balance sheet runoff that I was showing that the Fed has is that right as we approach the election is when the Fed starts hitting that balance sheet runoff percentage that they're comfortable with. So they wouldn't be surprised to be like, see the Fed basically be like, all right, stop the balance sheet runoff, make interest rates come down, because like supposedly everybody thinks that I don't know how much validity there is into that. I tend to be like a free market person, but that's definitely naive to think that. So yeah, I think that the election could play. I would say that one thing to think about is that I don't know if you guys know or remember, but when Trump got elected, everybody thought that rates were going to come down. Everybody was like, oh my God, Trump got elected. Like that's totally like nobody expected that. The market does not like uncertainty, and futures markets were like rates are coming down in the morning, and the exact opposite happened. Like rates skyrocketed because people were like, oh my gosh, Trump's in the market. Trump's going to be pro-business, and what ultimately, if the stock market is doing really well, interest rates are not doing well is kind of how it works. So it'd be interesting to see. I think that if my call is that if Trump wins the election, you may see coming up to the election, interest rates really low. He gets in office, they skyrocket. Yeah, I hope that answers your question.
And Kim, also about the Chicago transfer tax changes, I think that there's a lot of fear in this that isn't necessary personally, because if you look at what they're talking about doing, and this is still getting hashed out. They're talking about increasing the transfer tax on homes that are for sale that sell for $1 million plus. But what they don't tell you is that they're also, or what everyone's afraid about that, but what they're also doing, though, is they're actually going to reduce the transfer tax for those below $1 million. So and I don't know, there's a lot of buyers. I feel like it's actually going to work itself out in the end. I don't think it's going to slow down $1 million home buyers from buying $1 million homes. I think it's actually going to help home buyers that are trying to buy $400,000 homes.
The majority is struggling to get it, and like the majority is under $1 million.
Yeah. So my personal opinion is I think it's actually going to be better for my business, because I do a lot more mortgages for working families that aren't buying $1 million homes. They're buying $400,000, $500,000 homes. So it's like they're going to actually get a benefit from it. So
Yeah, I'm sure they're gonna land in the middle on that too, like because like it's gotta, yeah. So
Any other questions out there? I just, I have a lot of hope going into this year. I mean, I just want to, I personally want to end with this. I feel that this 2023 market tested us, like it tested all of us, whether you're the realtor or the lender. Those of us that had to like get back to basics, grind it out, fight for every deal. But now we're coming through it. And I feel that right now is the time to stay focused and get momentum now, because I believe when when rates dip a little bit more, there is going to be a rush. There's going to be a lot more folks out there. And I just want to say that our team is the best in the business. And I say that very proudly. Like, if you want your client to have an amazing experience from start to finish, and if you want to have an amazing experience from start to finish, we are on top of our game. Our team has over 20 years experience doing mortgages, but we really are about building the relationship, because we want to be your lender for life, whether it's our client or you as a partner agent. We want to build a relationship where 7 days a week, 24/7, you got a team, you can call them, they are on it, and your clients are going to be treated with respect, dignity. We're going to meet all your deadlines, close on time. So give us an opportunity. I know I see a lot of folks in Louisville that are on here. Dustin is awesome. So let's start doing some business. Let's get going here. And I'm really looking forward to 2024. We want to help you grow. So let's go.
yeah, one thing I want to tell you guys too, I got in the business in 2022, and that's 2002. So 22 years. And this in January, I started going through, Caleb and I have over 700 client database. So in January, I'm like, I'm going to call my clients, right? I started calling them, and something really crazy happened. They started referring me, believe it or not. And just a reminder, because I think we all forget how important it is to call your clients. Call your clients, wish them a happy new year. I had a client that I called that I hadn't talked to in a year and a half. We did a deal for him a year and a half ago during COVID. I called him, and he's just like, oh my gosh, yeah, no, I remember you. Thank you so much for calling me. The weekend comes, he's like, oh, a guy at my work is buying a home. He's under contract. Do you want him to? So that guy would not have referred me had I not called him. So don't forget your sphere and how important calling them is. And what I'm going to do now is, I was talking to Caleb about it. January, they get a call. In July, they get a call. So again, just total basics, but I've had an epiphany. I wanted to share that with you. So. Awesome.
All right,
I think we're good.
Yeah, I think we're good.
Happy New Year, guys.
Happy New Year. Let's get it. 2024. Let's go. Take care.
Thanks, everyone. See ya.